Let's get some more perspective now. We have Geoffrey Dennis, independent emerging markets commentator, who's now joining in. Geoffrey, hi. Thanks very much for taking the time out and joining in. Well, let's start with your whole entire outlook on the Indian markets, considering that we were just discussing how there was a large FII sell figure that we're reckoning with this morning. And separately, the Indian markets have been a bit cautious. They've been down for 3 days in a row now. Give us your sense in terms of how you're approaching India.
Well, I think what we've got to realize is that you've seen a very nice rebound in emerging markets generally in May. In particular, some of the markets like Taiwan, which did so poorly earlier in the year, have done very well on the back of concern over on the back of concern over tariffs beginning to ease as Trump starts to try to do some trade deals with individual countries. And so I think what's happened is India's been pushed a little bit onto the back burner here. In the short term, India's been a reasonably solid market taking the year as a whole. It has not been hit like Taiwan was hit earlier in the year, and China remains, in my opinion, very volatile. And so, albeit recovering also in May, and I think India's just taken a bit of a back seat here. But I continue to believe that the outlook for India is good, based on the strong economy, still strong economy, albeit possibly slowing, potential for interest rate cuts after that low inflation number for April, and obviously a very nice rebound recently in the rupee as well, which probably opens up room for the RBI to cut. And you've obviously got reasonably stable to slightly lower oil prices, all of which is good for India. So it's been a bit out of the limelight recently. And I think that just reflects that other markets have done better because of the big focus on in particular trade deals and what the prospect for trade deals could be.
All right. Hi, Geoffrey. Good morning and good to see you, Ben. What are you making of the US deficit numbers? Now, clearly, that's spooking sentiment a little bit because even overnight, you saw a flight towards, towards less risk assets. And a lot of those risky assets did get sold into. The yields have spiked up as well. How much of a worry is that for global equities?
I think it's a major long-term worry for global equities. So clearly, we were due some profit taking in equities because we had a very good run in the US. But I think what's slightly changed the outlook here in the very short term is the Moody's downgrade of the US from its highest rating, its highest debt rating, which came out on Friday. And that's started to weaken US bonds and pushing yields therefore higher. And I think that is coinciding, of course, that downgrade with the pushing through pushing through Congress gradually of this fiscal bill, this big beautiful bill, as President Trump calls it, which is going to add a lot more to the deficit. And so I'm very concerned about the deficit. I don't know when it's really going to hit. There is clearly some alternative pull on bonds through the risk of recession, which would tend to pull bond yields lower. But my view is bond yields are flat to higher from here. The higher risk, the risk of higher yields is because of the fiscal side, which is bad anyway. And nobody seems to care in Washington, D.C. about the deficit anymore. And the deficit is going to get worse if some sort of a bill like the one that is beginning to make some progress through Congress, if that is eventually written into law. So, yes, I'm very concerned about it.
You're concerned about it. So the question then is, what should one do with their portfolio allocation? Because gold is at a record high. Yields are increasing. So do you shift some of the assets to, risk-free assets, the yields because or the 10-year, if at all, or the fixed income? Yeah. And if you were to increase your exposure to equity or keep your exposure to equity same, in that, what would your pecking order be between developed and emerging markets?
Well, I think the key here is going to be, what does the dollar do? And the dollar's had a very nice rebound, a modest rebound recently. And then the last couple of days, it started to weaken again. So I think the dollar goes down again. And I think it goes down again because of everything that's going on in the US, the uncertainty generated by the tariffs and the trade war that is ongoing, the concern, of course, about the debt and the deficit once again, and risk that the economy is heading towards a major slowdown, potentially even a recession. So the whole idea of selling the US, if you like, I think is beginning to come back into the forefront again. So if you get that developing further, I think that's going to be very beneficial for emerging. And so my view remains, as it's been, it wasn't at the start of the year, but it very much is now and has been for a few weeks, that emerging markets will outperform developed markets, assuming these trends continue. And for that, as I've often argued on this show, the weaker dollar is very, very important. I think gold still looks good because if the sell US continues, and that will be very much driven by the fiscal side, I think gold will probably do well again, although I'm far from being a gold expert. And I think you've got to be very cautious about certain parts of the developed world in terms of equities, particularly the US. Europe less so. I think Europe looks in a better position. And at the same time, I think you're going to be very, very cautious about bonds.
You be cautious about bonds. You are sell US. You believe gold is going to do well, and Europe likely to do slightly better than the US itself. Thank you so much. Always a pleasure speaking with you. Wish you a very good day going forward.